Hello and welcome back to Principles of Accounting 1. I'm your host, Dr. B, and today we're going to be talking about the accounting cycle and completing the accounting cycle. We just got done talking about adjusting journal entries, which is one of the final steps of the accounting cycle. And throughout the past three chapters, now entering chapter 4, we've been talking about the accounting cycle this entire time. You just haven't really probably recognized that. The accounting cycle are the steps that we take in business to complete the accounting process. Everything's step based. Accounting is a very step based process. We follow certain steps and guidelines to do proper accounting, right? And so, as long as you follow the steps, you'll be all right. You've identified that we first started talking in this class last week about journal entries. We took very basic stuff. We talked about it needs a date. There's a debit account. There's a credit account. The debit and credits equal. And there's a note, and that's your journal entry. We talked about how that journal entry impacts the income statement, balance sheet, statement of cash flows, statement of retained earnings. Then we talked about just now, recently, we talked about adjusting journal entries. The adjusting journal entries, we make those at the end of each month. It helps us to recognize revenue and expenses when they were incurred. It also helps us to identify any possible errors that we may have made, and we made corrections. That's journal entries. All of these things are part of the accounting cycle, which we're going to talk about now. So after we've made our adjusting journal entries, we prepared our trial balance. And after we prepared our trial balance, we prepared our income statement, balance sheet, statement of cash flow, statement of retained earnings for the final version of the year. And we're closing out the cycle. So, and when we talk about this process, sometimes we use a worksheet in Excel. And that worksheet helps the accountants to prepare the financial statements. It helps to reduce errors. There's a link to the accounts. It helps in the inter-financial statements, and it also shows the effect of transactions. The worksheets are just there to help, okay? It's not a required report. Think of it like an Excel workbook, right? It's just there to help you to balance your books. Not required. It's just an optional thing that we in accounting do sometimes. I personally, as a professional accountant, I haven't done this in a long time. Okay, I haven't used a workbook and a worksheet in a long time because I really haven't had the need. I've used QuickBooks. I've used NetSuite by Oracle. I've used M3. I've used other accounting softwares. In modern day, we have software to do these things for us. So we don't have to be screwing around with Excel, okay? Or a ledger, God forbid, if you're still using the paper and pen, okay? In modern day, we use software. So if you have a small business and you're still using Excel to track your transactions, please stop that. Please stop that. Go get yourself a piece of accounting software like QuickBooks or NetSuite or whatever. FreshBooks. There's a whole bunch of them out there now. Get yourself some software. I promise you it'll help. It costs a little bit of money. Sure, absolutely. Any investment does. But I'll tell you what, if you buy the software instead of using Excel, by the time you reach the end of the year and you're getting ready to do taxes, guess what? That software is going to do it for you. Okay? so you don't have to be stressing and trying to figure things out. That's why, as a small business owner, I've always used like QuickBooks or some type of software. It really, I promise you, it helps to reduce the stress, and you won't have to use this worksheet that I'm talking about right now. um, when we use a worksheet, we look at we prepare the unadjusted trial balance, enter the adjusting entries, then we prepare the adjusted trial balance. We verify them, reconcile them to the financial statements, and we prepare our income statement, balance sheet, statement of cash flows, statement of retained earnings. This is what it looks like in Excel. It has the account names on the left, unadjusted trial balance, then our adjusting entries, adjusted trial balance, and then the income statement, balance sheet, statement of cash flows, statement of equity. It is only designed to help you. It's not a required thing, but it just helps us to identify any type of errors. Makia, go ahead.
Hi, I'm sorry. Can you
Sure.
go back to the last slide just for like 2 seconds?
Sure, of course.
Thank you.
You're
That's
very
all.
welcome. So let me ask you, Makia, are you using this type of process or no? You just want to know it.
I just want to know it,
Okay.
I would like to, my plans is to be the jack of all trades.
Okay. All right. I like that.
So if I get there, learn
I
all I can.
I got you. Yeah, you'll probably never use this. I'm just saying that now.
Good to know. Good to know. Thank you.
Yeah, the reality is, accountants, we don't use this worksheet anymore. This was helpful. Like, when computers first came out, okay, before these softwares that we have now, this was super helpful, because a lot of times the business owners used Excel to track their books, right? To track their transactions. And that was totally normal back in the 90s, early 2000s. But then,
So
go ahead.
we won't need it now. I mean, we won't need it now, but will we still need it in like our midterms, our questions, homework? Are you sure?
No,
'Cause
no,
okay.
no, 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 no. You won't see this again.
Thank you.
but
Okay.
but if you're looking to do accounting using Excel, then this would be helpful for you.
Yeah, because I hear some government agencies are a little bit just a little bit stingy as far as with their money.
Oh, I know they
They're a
are.
little old fashioned.
I know they are. I know. I got friends that work for a couple of government agencies in DC, or around the city, and they, yeah, sometimes they do this.
Mm-hmm.
Yeah, yeah, good point. Yeah, this is what it looks like. It's easy to use. It's just, again, with the modern technology, it's not something that's really, in today's day and age, it's just not as practical. But it's there. This is what's important. This is the important part from this chapter. Uh, at the end of the accounting cycle, we do this thing called a closing process. Okay. We reconcile our transactions. We It's called closing out our temporary accounts. Here's how it works. Okay. At the end of the year, uh, your temporary accounts need to go back to zero. What do I mean by that? Your balance sheet will always have balances. It doesn't reset itself at the end of each year. The balance sheet has what we call permanent accounts. You're always going to have cash. You're always going to have assets. You're always going to have liabilities, and you're always going to have capital. Those are all on your balance sheet. Your balance sheet accounts will always be there. Okay? Your cash doesn't go to zero at the beginning of the new year. No, I still have cash from last year. Your liabilities don't go to zero at the beginning of the new year. No, I still owe money from last year. Your capital, your equity accounts, they don't go to zero. You still have investments in the business. Those are called permanent accounts. Once the business is created, those accounts will always be there. There will always be a balance in those accounts on the balance sheet. Those are permanent accounts. They live with the business. What we do close at the end of the year are our temporary accounts. I start, and every business starts, the new year with no revenue, no expenses. How could you? You couldn't. You can't. I can't even start the next month with revenue and expenses. Okay. At the end of the accounting cycle, we close our temporary accounts to start the new year or the new month fresh. For example, right now we're in January, okay? My company has revenue from sales I made in January. My company has expenses from expenses I incurred in January. At the end of January, I need to close my revenue and my expenses because I can't start February with sales that didn't happen in February. Does this make sense? I can't bring my expenses from January into February. I can't bring my revenue from January into February. It stays in January because that happened in January. Okay, your revenue and your expenses get closed out at the end of every month. Here's how it works. We know that we increase expenses with a debit, and you've been doing that throughout the month of January. We also know that you increase your sales accounts, your revenue accounts, with a credit throughout the month when you make your sales. At the end of the month, I close those out to this account, a temporary account called income summary. Here's how it works. So on January 30th, on the last day of this month, whatever that is, I think it's the 30th, I'm going to do the following. I'm going to debit my revenue accounts and credit income summary. I'm going to debit income summary and credit all of my expenses. Then I take my income summary account and I take the balance and I allocate it to retained earnings. What that does is it closes out the temporary accounts from your income statement and transfers the balance of your revenue minus your expenses over to your balance sheet under equity, also known as net income. Also, net income is a part of equity, right? And we learned that back in the first or second chapter. So let's walk through it, the closing process. I need to reset my revenue and expenses and my withdrawals. And I got to get those to zero for February 1st. Because remember, I cannot bring revenue expenses into February that happened in January. They belong to January, not to February. So I close my temporary accounts. The way that I do that is by allocating the revenue and expenses to income summary. The income summary account is a temporary account that only exists for this purpose. So the first step of the process is identify the accounts I need to close. I need to close all of my revenue accounts, all of my expense accounts, and any withdrawal accounts. I record what we call the closing entries. I'm going to debit income summary and credit all of my expenses. I'm going to debit my revenue and credit income summary. And all that's doing is I'm moving my revenue and expenses to the income summary account. And then I take that income summary account and I move it over to my statement of retained earnings, which eventually makes its way onto the equity part of the balance sheet. We do that through this process of the closing entries. So here's how it works. Credit balances to revenue to income summary. Debit balances to expense to income summary. Income summary to owner's capital. Closing and withdrawals to owner's capital. And it flows onto your balance sheet. That's the process of closing the temporary accounts. Questions? It makes sense?
Yes.
Okay. I know it's a lot. But the concept here is that we can't start a new month with revenue and expenses that are already there. No, you can't do that. If you did that, obviously there'd be a huge error. It's like saying, everything I earned in January is also in February, and then I keep adding to that and adding and adding. No. You can't do that. Because remember, the revenue recognition principle and the expense recognition principle, also known as the matching principle, tells us that we need to recognize revenue and expenses when they are incurred. So if it happened in January, it stays in January. Then at the end of the month, we go through the closing process. We transfer the revenue and expenses to income summary to our owner's equity into the balance sheet. It goes through that flow. Yeah? And that is the process of closing. After I've closed my temporary accounts, then I prepare this thing called a post-closing trial balance. What this does is it verifies, this is the process of verifying, that I have properly closed out my temporary accounts. I list out all of my balance sheet accounts, which are permanent, and then I verify that I have closed out my temporary accounts. And remember, your debits and credits must always be equal. So here's an example of the post-closing trial balance. I list out my balance sheet accounts. Okay, cash, accounts receivable, supplies, also known as inventory, prepaid insurance, equipment, accumulated depreciation, accounts payable, salaries payable, unearned revenue, capital, etc. Remember, your debits must always equal your credits. As long as that's true, you've done it correctly. So let's recap the accounting cycle. These are the 10 steps. Technically, it's 9. The 10th one is optional. The 10th one is your worksheet. Okay, first step. Analyze the transactions. Remember when we did that? That was a fun exercise. It was back in chapter 1. Yeah, chapter 1. We looked at the impact of transactions on the accounting equation. Assets equals liabilities plus equity. We went through a ton of different journal entry examples or transaction examples and their impact on the accounting equation. That was chapter 1. Then we began to journalize the transactions. A journal entry is a record of the transaction. There's a debit account and a credit account. The debits and credits equal in each transaction. Journal entry. Once we've made the journal entry, we post the journal entry to this thing called the general ledger accounts. These are also known as T accounts. And the T accounts represent the balances of those accounts over time. Also known as general ledger T accounts. Yeah. So that was chapters 2 and 3, thereabouts. 2, 2, 3, 1, 2, 3. Chapter 4, 3, chapter 3, more chapter 3. We talked about the fourth step of the accounting cycle, which is called the unadjusted trial balance. We looked at the balances before we made the adjusting entries. Step 5 of the accounting cycle is to adjust and post. The adjustment part is when we make the adjusting journal entries at the end of the month to recognize the consumption of the expense or the consumption of the revenue, etc. The adjusting entry. We posted them to the ledgers. And then step 6 is we prepared an adjusted trial balance. It showed us the balances before the adjusting entries, plus or minus the adjusting entries, which leads us to the adjusted balances based off the adjusting entry. And after we've done that, then we prepared our financial statements, our income statement, balance sheet, statement of cash flows for the year, statement of equity. And then we close our accounts. The closing process is we close our temporary accounts. Remember, temporary accounts are your income statement accounts. Revenue and expenses are temporary accounts because we close them at the end of each accounting period. At the end of each month, we reduce our revenue and our expenses to zero by debiting or crediting to income summary. And then income summary goes to our equity account. Well, step 9 is we prepare a post-closing trial balance which verifies that our debits equal our credits for all of our permanent accounts. And then step 10, if you need to, well, it's just a part of the worksheet, but step 10 is if you need to reverse any entries. This happens once in a while. You make a mistake. Accountants make mistakes. Okay? We all do. Everyone makes mistakes from time to time. So you might need to reverse an entry. It's just a matter of reversing the debit and the credit to reverse it back. It's like a correction. It's rare, but once in a while it happens. And that is the accounting cycle. But this is really the foundation of what we do every single month. When we follow all these steps every month. That's the accounting cycle. It's a nice picture. I like it. On the balance sheet, when public companies do this a lot. Public companies will create what we call a classified balance sheet. It's real simple. All they do is they condense the accounts into a very short format. What do I mean by that? We see that there are classifications, right? We have assets, liabilities, and equity. Within these classifications, we have what's called current assets, non-current assets, current liabilities, non-current liabilities. Non-current also means long-term. You might hear long-term or you might hear non-current. It's the same thing. What the word current means 12 months or less. Current means 12 months or less. Examples of current assets are cash, accounts receivable, inventory. Those are current assets. There are a couple more examples, but the word current assets simply means I can quickly convert into cash within that 12-month period. Current assets. We also have what we call long-term or non-current assets. Another word for this is called fixed assets. Fixed assets. Fixed assets, non-current assets, or long-term assets. All three of those terms mean the same exact thing. They mean long-lived. Okay? And that would include things like property, plant, and equipment. Also, intangible assets like trademarks. Property, plant, and equipment, trademarks, etc. Something that lasts longer than a year. Under liabilities, the classifications are current liabilities and long-term liabilities, also known as non-current. Current liabilities include things like accounts payable, wages payable, taxes payable, anything payable. That's current. That's current. And current liabilities means it is due in 12 months or less. We have to pay that in 12 months or less. That's a current liability. Non-current liabilities or long-term liabilities would include things like mortgage payable, card note payable, notes payable. These are long-term liabilities. We pay them for longer than a year. And then the last one is equity. Equity is owner's equity. Equity includes things like paid-in capital. It includes things like net income, paid-in capital, bonds, stocks. Those are all equity. So that's everything we just talked about. This kind of breaks it down, right? The reason why we have what we call a classified balance sheet is it classifies the assets, liabilities, and equity as assets and liabilities as either being current or long term. The reason why that's important is because as a manager, a business owner, you need to understand what the difference is. Current versus long term. Remember, current, due within a year. Long term, greater than 12 months. The reason why you need to know that is because you need to understand how this will affect the business. If my current assets are greater than my current liabilities, that means I can pay all of my current bills, right? Simple. My current assets are greater than my current liabilities. I can pay all my current bills. Current assets divided by current liabilities, we call that the current ratio. Current assets divided by current liabilities is called the current ratio. It tells me, do I have the ability to pay all my current liabilities? And the only way I would know that is through looking at the classified balance sheet. That's why it's important to have that type of classification. So current, remember the word current means 12 months or less. Current assets, I expect to utilize those assets within 12 months. Long-term investments, long-term assets, things that hold on to for greater than 1 year. Property, plant, and equipment, those are tangible assets that are greater than 1 year. Property, plant, and equipment. These are also called fixed assets. Intangible assets are things like a trademark, a patent, intellectual property. These are things that I cannot physically touch. I can't physically touch a trademark. I can't physically touch a patent. I can't physically touch intellectual property. It lives, it's not, you can't hold on to it. It doesn't have a physical form. That's what it means to be intangible. Can't physically touch it. Current liabilities, anything due within 1 year or less. Current, accounts payable, wages payable, taxes payable. It's due within 1 year or less. Long-term liabilities, mortgage payable, notes payable. I'm going to be paying it for longer than 1 year. Long-term liability. And then, of course, equity is anything the owners own. So to include things like capital investment, also known as owner's capital, net income, stockholders' equity, bondholders' equity, etc. What the owners own. Ratios. I know, kind of math, a little math, sort of math. Ratios. Ratios are important in accounting. The reason why they're important is because they tell us quickly the financial health of the company. If I am a business owner, I want to know how healthy my company is financially. I want to know how long I can survive. I want to know, do I have the ability to pay my current debts? I want to know how I'm doing. That's why financial ratios or accounting ratios are so important. The current ratio is very useful. It's quick, it's easy, and it tells me if the company has the ability to pay its current debt. And here it is. Do I have the ability to pay my current debt? I take my current assets divided by my current liabilities. Anything greater than 1 is really good. Okay? That's really good. If it's less than 1, it's okay for a little bit, but not long term. You don't want it to be less than 1 for a long time. Why? The reason is because if your current assets are less than your current liabilities, there's a chance you could have trouble paying your current bills in the future. That's why this ratio is so important. Sometimes, and I had said this earlier, sometimes accountants make mistakes. Okay? Business owners make mistakes. We all make mistakes at some point. So we can fix things. Sometimes you might need to make what's called a reversing entry. It happens from time to time. Sometimes we screw up, so we need to make what we call a reversing entry. It's simple. So what we do is we reverse the entry. If it's like, for example, let's say I had a problem accruing payroll. I accidentally accrued a few too many days of my employees' wages. Okay, it's a small problem. It's fixable. So the first entry is I had debited wage expense, credited wages payable. That's how I accrue wages. Well, let's say I accrue too much. I can reverse that entry. Debit wages payable, credit wage expense. All you're doing is you're reversing it. Okay, to fix it. That's what you're doing to fix it, and that happens. It. We all make mistakes, but if you make a mistake, you can't just delete the transaction. Never do that. If you're doing anything with accounting, never delete a transaction. Ever. Never, 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 never. Don't do that. If you made a mistake, you correct it with a reversing entry. Just reverse it out. Don't delete it, because I'll tell you what, if the accounting system, the software, it tracks every keystroke. Okay, every time you hit a button on the keyboard, it records that. Okay, so if you made the journal entry and then you delete it, guess what? There's a record of you deleting it. That is a red flag with the company, with the IRS, with someone. Okay, so instead of deleting the transaction, just put a reversing entry in. It's okay. Zach, question?
What's the most reverse entries you've seen on a single journal?
Wages is the most typical. Like this one right here, this example is actually perfect because this is probably the most common one. Sometimes what will happen is, especially with wages, usually wages at the end of the year, uh, that's usually the most common mistake because it's easy to make that mistake. A lot of times, what it has to do with, Zach, is uh, the employer might withhold too much taxes from the employee's paycheck. I've seen that happen. It's not uncommon. So what happens is the employer has to reverse the taxation entry by adjusting the wage expense and by reversing it. And then typically what happens, Zach, is the company has to pay that what they accidentally withhold back to the employee, right? But yeah, that's probably the most common one. A lot of businesses make that mistake, especially small businesses. Very, very common. Um, I've seen some other silly ones like, sometimes what will happen, especially in a very busy office, like let's say you get a bill from one of your vendors, right? You entered the bill, but you forgot to put the stamp on that paper, and then you enter the bill again. I've seen that happen. That's a common mistake. It's like, oh, whoops, I entered the same bill twice. Well, what does that do? It doubles the expense. So then you have to back that bill out. But that's another common mistake.
Quick follow-up question.
Yeah.
So you're saying as long as you keep your um, your supporting documents, your documents,
Mm-hmm.
they, these these fixes can be pretty easy as
Yeah.
long as you keep source documents.
100% right. Yep. So I'm glad you brought that up, and that's something we talked about in the very first chapter, if I'm not mistaken. We talked about this thing called source documents, and that would include things like invoices, pay check stubs, uh, the paperwork, right? The packing slip, the invoice, the purchase order. We staple those things together if it belongs to the same transaction. We put that information in front of whoever's entering that information into the accounting system. When they enter that expense into the accounting system with a journal entry, typically the way it should work is they put a stamp on it or they somehow sign off by physically writing on that paper, entered initials, date, and then they file it away, right, with the rest of the paperwork. That's a paper trail. Okay, so Zach, yes, the way you prevent these types of mistakes from happening is you have an established process, and with that established process, you are establishing a paper trail. And so, if you at the end of the year, if you're like Zach goes to his books and he looks at it and goes, "Man, that one expense looks a lot higher than it should be." He goes into the accounting system, sees that somebody accidentally entered it in twice. He can make the reversing entry and correct it. Or, God forbid, the IRS and comes and audits your business. Okay, if the IRS comes to audit you, you have the accounting software, you have all of your financial statements, you have all of the supporting documents, the source documents to support every single transaction. That's why it's so important to have an established process in place. And also it helps prevent errors like this. Very good discussion. Cool. Cool. Yeah, I mean, sometimes the reversing entry is necessary. Sometimes it's not. It depends, but in most cases it is. If the whole transaction is incorrect, which happens from time to time, especially with salaries. Questions, comments, concerns? No, you all good? You all sleep?
I'm still here. I'm still here.
Mike's still here.
I'm trying to keep my eyes. I've been up since 7, but I'm gonna keep my eyes open and focus on this class.
There you go. That's what's up. Yes, thank you so
I
much.
have a question.
Yes, Miss Edwards.
Yes, uh, um, going back to something I think you said for discussion board.
Yes, thank you so
You
much
said-
for bringing that up. Yes.
You said this. Oh, well, go ahead. I'm listening to you now.
I sincerely appreciate the reminder. Okay, so in the classroom, now remember, every single week, since we cover two chapters, that means you got 2 things to do by Sunday night. So, come into the classroom under content, course content, come down to module 1, select the folder that says week 2. In week 2, you owe me 2 things by Sunday night. The first is the chapter 3 quiz. That's the quiz on reversing entries from the chapter we just talked about earlier.
Week 2, chapter 3 quiz.
Chapter
Week
3
2,
quiz.
chapter 3 quiz.
Week 2, chapter 3 quiz. You got 2
Okay.
attempts on it. It's 5 questions, true, false, multiple choice. Pretty straightforward. It's on reversing entries. You also owe me a chapter 4 discussion board. Okay, here's how it works. You click on the chapter 4 discussion board. It opens up like this. You need to answer in writing 3 questions. You need to answer these 3 questions for me. Okay? Now, with discussion boards, here's how they work. Now, remember, each discussion board is worth 5% of your total grade. Don't skip it. Please don't skip it. You don't want to forfeit half a letter grade. Please do this. Okay, so here's how it works. You'll come in, you'll look at these 3 questions, you'll look at your notes, you'll look at the PowerPoint, you'll look at the lecture. You could also use outside resources. If you find a nice website that helps you to answer these questions, you're more than welcome to do so. Now, what you'll need to do is you'll come in here and you'll start typing out your response to all 3 of those questions. Please make sure that when you're typing out your response, that it's in full paragraph format. Full paragraph format. No, please don't do any lists. Please just do full paragraphs. And please include any references. If you find a website, if you're using the textbook, please reference those. It doesn't have, try to get it in APA format. If not, it's okay. But just make sure that you identify where you found the information. So that's the first step. Paragraph, answer those questions with a reference. The second step is you need to respond to 2 or more of your classmates with full paragraph responses. So I could come down to someone who already wrote theirs and say, hey, this is a very good response. I also found that X was interesting. Have you thought about this? Full paragraph response. You're asking an engaging question. That's a proper response. Make sense?
Okay.
Does it sound easy, Miss Edwards?
Oh yes, I sort of did that a little bit on my last discussion board as I responded to my. I kind of did a little bit of that. That's just that's what I naturally do. I did that. I did.
Well, as
Okay,
long as you do it that way again for this one, you're good to go.
I want to be straight. Okay, week 2, quiz 3, chapter 4, discussion and answer two of my classmates' discussions.
You got it.
Got it. Yes, sir. Thank you.
Thank you.
Sunday, 11:59, deadline.
You got it.
Thank you, sir.
Thank you, Miss Edwards. Celine.
Thank you.
Thank you. Celine.
Yes, Professor. I was trying to access the PowerPoint for chapter 1, and it gave me a server error message. It said 404, the file or directory not found. The
Really?
resource you're looking for might have been removed, has changed had its name changed, or is temporarily unavailable. I don't know.
I see it. Weird. Okay, no problem. I will fix that for you. Thank you for bringing that to my attention. Something obviously must have happened there. So let me. Yep, I see it right there. Let me fix that. And
and that was for chapter 2 as well. Like I was like,
it was awesome.
Mm-hmm.
Okay, thank you so much for telling me that. I will fix those problems. I appreciate you letting me know. That is very helpful. So I just fixed the chapter 1 PowerPoint. Oh, what is going on here? I will contact the help desk and find out what's going on. That is unusual.
Sorry, Professor. Thank you.
No, that's okay. I appreciate you bringing that to my attention. Sometimes I get silly. You know what, Celine? Try this. Celine. In the classroom, you're looking at. I'm going into student view now. Okay, so now I'm the student. I come down to module 1, week 1. I come down to PowerPoint. So Celine, here's what we need to do. Instead of clicking on that part, just to the right, you see this one? It has like a little letter A, the arrow. Click on that.
Okay, let me try now.
And then select, PDF or something. Maybe that'll do it. It's probably a change that they made, with the Blackboard. But of course, they didn't tell me.
Yes, Professor. I hate that. They keep changing it every semester.
I know. It drives me crazy.
I know. Grinds my gears too.
Yeah, I hear you.
Oh, got it, Professor. It did download it.
It worked that time? All right, cool. I'm sorry about that. I don't know what's causing that to happen. Well, you can also, just so you know, Celine, you can also select the one with the little 3 dots next to the A, You select that and then select download original file. And that should download. Oh, no, it brought me to the error message. Huh. Okay, well, I'll talk to the help desk.
It's a mystery now with this.
Yeah, exactly. Yep.
Professor, I did get my bright wave through the email,
Great.
and I tried to get into it, but something's the password is not right. And I'm talking to the guy at Brightwave, and he said he'll help me he's gonna get back to me tomorrow and help me because he said it's a problem, and he couldn't get it through either. So we're gonna talk tomorrow.
Yep, sounds about right. You know how those technology issues are.
Yeah, but I use the PowerPoint and everything to kind of do my work, and I kind of went through that a little bit like that and my notes.
Perfect.
So, okay.
Great. Sounds good. Okay, so what I'll do, Selena and everyone else, is I'll try to get those PowerPoints fixed. For some reason, as you pointed out, they're not downloading correctly. So I'll find out why that is and get that fixed. But thank you so much for bringing that to my attention.
You're welcome, Professor. Yeah, you're right. It might be a change they did like before, because before the end of last semester, I remember they also had the same issue with another class.
Oh, really? So okay.
Yeah.
Well, that's good to know. Okay, at least I'm not the only one. Awesome. Great. Any other comments, questions, concerns? Y'all good. Y'all know what to do. Now remember, we're in week 2. So course content, module 1, week 2, chapter 3 quiz, do Sunday night, 2 attempts, chapter 4 discussion, open up the discussion, full paragraph responses, my friends. Full paragraph responses. Thank you, Audrey, for fixing yours. I know you're working on it. I appreciate that.
You said at least 2 attempts, right?
Yes. On each.
I mean, not attempts. That's not what I meant. At least 2 replies.
Oh, on the discussion, yes. On the discussion, I'm looking for full paragraphs answering these 3 questions. Okay, for your first post, your original one.
There's full paragraphs for all 3 of the questions?
Yeah, so your original post should answer all 3 of these questions. Feel free to use outside sources. Feel free to use your textbook. Whatever you use, though, make sure you provide a reference. Yes, cite it. Exactly. Cite and reference. Yep. And then once you've done that, then go ahead and respond to 2 or more of your classmates with full paragraph responses.
Okay, got it. Thank you, sir.
And as long as you do those things, you're good. But thank you all so much for your time today. I sincerely appreciate all of you. And as always, please stay safe, wash your hands, do the right things, and I'll see you all again this time on Monday. Monday at 5:30. I'll see you this coming Monday, 5:30. Okay? Thank you all so much.
Thank you, Professor.
Thank you, Professor. Stay